Welcome to the YouTube channel. I hope you find this as a resource for all index-based insurance products, and that you might find answers and value to what you're doing. We're going to dive into, though, a core concept that we can utilize about how to make money like the banks, right? Isn't that something we all would love to do? Before I go into the actual concept, I just wanted to point out an overall philosophy that we have here at All Things Index. We want to help people build a strong financial house. Okay, and as you know, with any structure, the foundation is key. Strong foundation is key to having a structure that lasts. And the same thing is financially. You want to be able to build on a strong foundation. And so your house needs to be built on a strong foundation to weather the financial storms of life. Now, this concept that I'm going to share is, there's lots of different ways to save and invest, lots of good ways to save and invest. Does this have to be the only thing you ever do? No, but we do feel strongly that this is a foundation to build upon, okay? And you'll be able to see why here in a little bit. So let's dive in. We want to ask the question, what are banks doing with our money? Right? What they're doing is when we deposit money into the account, right, it goes into the bank and it starts building their reserves. It becomes their money, right? They get to do with it what they want. And so if we have this local bank here, let's say they have $100 million, okay, just to throw out a number. Well, instead of lending out that 100 million in the way of mortgages, car loans, and credit cards, what they typically do is they end up going to the Federal Reserve and they say, hey, can I use my money to back up a loan from you guys? And they say, sure. And they send them over the money. Now, although they can get various amounts from the Federal Reserve, let's just say it's an equal amount in this case. So they have 100 million that they've borrowed and 100 million of their own money. The thing is they can't really lend out their own money because they need it in case you and I come to the bank and say, hey, we want our money. And so they need to keep that reserves there. So what they end up lending out is actually this money that they've borrowed. And that's why when we borrow from the bank, we get this structured payment plan that you have to qualify for with credit and things like that, because they need to make sure you can make your payment so they can make their payment. And so most people would agree that this flow of money is actually very lucrative and very highly successful, and banks make a ton of money doing this. So the question then becomes, can we do it? Are there companies willing to lend us money like the Federal Reserve does with the banks? And the answer is yes. Insurance companies are willing to do that. All right. And so how this works is that you start to deposit your own money into your own account within the insurance company, start building your own reserves. As you build your own reserves, what happens is that you have the money in your account and you have the insurance company. And let's say you wanted to make a purchase or plan for retirement or something like that. But as an example, let's say these books are a student loan or some sort of a debt, right? So if this is a normal bank account and I wanted to pay off this student loan, what would happen is I have to obviously take the money out of the account, go pay off the student loan. Pretty simple, pretty straightforward. But what if you could keep the money in the account and still pay off the student loan? How is that possible? Well, just like how the bank says, hey, Federal Reserve, you can say, hey, insurance company, can I use my money to back up a loan from you guys? They say, sure. They send you the money out of your own pocket and you pay off the student loan, while 100% of your money stays in the account, continuing to grow and generate interest for life, right? Now, the gotcha is whatever they've given you here is now unspendable over here, but the key to the principle is that 100% of the money still in the account, still growing and generating interest, where the alternative is that the money's gone, never to do anything for you ever again, right? The other aspect of this is that borrowing from an insurance company is different than a bank. Okay, they still give you money with interest, but you get an unstructured payment plan. There's no qualifying or credit or things like that. And what I mean by unstructured is that there's technically no required payment, right? You have the flexibility to pay this back whenever you want, however you want, whatever time frame you want, whatever amount you want. In fact, if you do it the right way, it can pay itself back automatically when you pass away, right? So you have so much more flexibility. You get to keep the money in your account growing and compounding for the rest of your life. Is that not a foundation that you would want to build upon?